Hello, and thank you for joining us. I'm Gary Wagner. I'm the president of Carnegie Investment Council, and this is the front row where we take a deep dive with some of our thought leaders at Carnegie on current hot topics. Happy to get started here with Greg Halter. And first topic I'd like to ask is can you talk a little bit about our artificial intelligence and, is it hype, reality? And what are you seeing out there?
Great question, and certainly top of mind for many out there. Is it real? Is it hype? I don't think we're actually going to know that for many years. Companies that we all know and recognize, like Microsoft and Google, and even newer companies like OpenAI, Anthropic, of course, the existing companies, Meta, Amazon, everyone is trying to get into the artificial intelligence area. They see this as a potential huge game changer, if you will, in terms of the information that is able to be generated by using AI across a wide variety of areas, including healthcare and financial services and many different areas. And again, I don't know that anyone has the crystal ball to say whether or not it's real or hype. I know we use some of the tools in our office here, and they definitely can save time. We do see some bumps along the road in terms of the usage of those products where they still need to be refined. The companies themselves who are deploying this in terms of the high level are spending billions, if not maybe into the trillions. So the answer to your question, Gary, is nobody knows at this point. So we're definitely paying attention. We're hoping to be able to benefit from some of the spending in terms of some of the investments we make with our client dollars.
And to follow up with that point, Ben, what are your thoughts on to the best you can? What are you thinking in terms of sectors of the market that could benefit from AI?
Yeah, I think if you look at the technology sector and the companies that are actually sort of executing on AI, you have, Greg just mentioned a couple companies like Microsoft and Google. They're obviously driving the bus and determining how much money is being spent and where it's being spent in AI. They also have developed actual business models that use AI and generate revenue off it. So you have those companies that benefited. And then currently the supply chain companies, the memory companies like Micron are benefiting, but it's for them, it's how long will that benefit last? And is it all due to just sort of the current supply chain crunch that's driving their margins higher? Is that only benefit? And then you have the companies that will be disrupted by it, like software companies, you know, companies that are sort of consumer focused and not part of the enterprise workflow. It seems like they could be easily disrupted by by AI. Software companies more integral to an enterprise workflow, less disrupted. And then it's going to permeate through businesses. Like Greg mentioned, we use it here at Carnegie. Um, every company, banks are investing in an AI, insurance companies are. They're all trying to use it. And it's kind of like right now it's in a sort of a testing phase, and let's see how it's going to work. But down the road, definitely there'll be efficiencies, but long term, what are the best investments? It's still uncertain.
Great, thanks. And it's clearly going to be an interesting thing to watch over the next months and years. It's an area that obviously is going to continue to get a lot of attention, if not more, in the future. So thanks for that. Shifting gears a little bit. The first quarter where the market was down, and the second quarter, I think, was the 12th best quarter for the S&P since inception. And what are you seeing in terms of the underpinnings of the market? Is it broadening? There's sector rotations. What's kind of driving performance right now?
Yeah, first quarter was a sort of broadening the market. Energy was the big driver. Second quarter, it was all about tech and more specifically semiconductor companies. In Carnegie, I think we're looking, the market leadership is likely going to broaden. Just we cannot continue to see the exponential climbs in the semiconductor companies. I think you've already seen it with some recent results from Samsung and Micron. They've had great results, but they didn't meet elevated expectations, and their guidance didn't meet elevated expectations, so they pulled back. So I think you've started to see it, and now it's going to be it's going to be more than just AI and AI supply chain companies. It's got to broaden to other companies, and maybe some of those companies that aren't disrupted by AI, and how they're going to benefit from using AI themselves and then make their operations more efficient. So I think you could see some other sectors being the leadership in the second half of the year.
Great. Planning is a big part of what we do at Carnegie for clients, and got fortunate to have Mike Curry, one of our senior financial planners, with us. Either one of those topics. How do you translate that into what's going on in the market into somebody's longer term financial plan?
Yeah, it's a great question. I feel like in client conversations year to date so far, been hearing and having more conversations around where performance has come from this year relative to previous years and how, prepared client portfolios are for that. Because I think if we look back at the last couple of years, Mag 7 really drove market performance for a lot of people. We saw that change, especially through the first half of 2026, where, and that's pretty common for companies that make significant capital investments. We kind of see somewhat of an underperformance over the short term relative to the market as a whole. And so we then started to see that AI trade kind of spread out throughout different areas of the market. So all of a sudden, some of the high flying positions that were delivering, or some of the high flying positions that started to deliver returns, were from rather smaller allocations and portfolios, depending on people's situations. And so this is why, when it comes to financial planning, like portfolio diversification is really important, so that clients have capital they can draw on in retirement, regardless of the market conditions that we're faced with. If you're in the accumulation stage of your life, yeah, maybe some amount of diversification matters a little bit less. You have time to be more aggressive. And so, say, depending on people's stage of life, accumulation versus retirement, very different conversations, very different situations that those two groups of people are in right now. But largely, these conversations have been centered more around, the change in where returns are coming from.
Great. Thank you. Greg, you former bank examiner, are going to shift the topic to the Fed and what's going on at the Fed, and what are you seeing there? Obviously, we've got a new Fed chairman, and what are your thoughts around where things are headed?
We do have a new Fed chairman, and he's attended the first meeting so far, and it looks like the bias is towards potentially higher rates to fight inflation. We've obviously had big inflation in 2021, 22. It eased back, and with this latest conflict in Iran, oil prices have risen, and that's certainly led to higher inflation. Although when you look at some of the expectations, at least for future inflation, they may not be as high as they are currently. You see some pressure on companies like Walmart to lower prices, and I think it's 15% of their prices, 15% of their goods. I believe they're going to be dropping prices, or at least that's the plan. And obviously, Walmart is a huge company that has quite a bit of their tentacles across the country. So, if Walmart starts doing that and it spreads to other companies, that could be a great benefit for consumers out there, may take some pressure off the Fed. And of course, we're talking maybe 25 basis points. If you're looking at rates and you're at 4%, 4.25% would be the 25 basis points. that's really not a big deal. It's more the direction of those rates. So if we're talking a rate hike cycle, that's what would be more concerning to us versus just the amount, because we certainly don't see 50 or 75 or even 100 basis point change in any one Fed meeting. So again, it's more the direction than that that absolute number that may be thrown out there.
Great. Ben, I'd like to get your thoughts on how does this all kind of come together with what you're doing with portfolios from a strategy standpoint, both equities and fixed income?
Well, with rates where they are now, you can obviously get a short-term rate, and that allows you on the fixed income side you don't need to take added duration risk, which is good because the added duration risk means your portfolio is more sensitive to the general interest rates in general. And if you can shorten that duration while getting decent rates, then you create a less volatile fixed income portfolio. So with the rates where they are now, that helps a little. On the equity side, as Greg mentioned, it's more about the direction of where the rates are going, and and if the Fed hikes rates 25 basis points, I don't think that'll be a huge impact on the equity markets. Uh, It'll come more into play if there is, as Greg said, a rate hike cycle, and you expect more rate hikes, then that'll have more of an impact. We don't think that's likely. So we're more building in the likelihood of maybe a hike, maybe two, but not a continuous cycle. And then therefore it's more focused on quality companies that can function in the current environment and continue to generate positive cash flow and sustain margins. And so that's quality and diversification you want in the equity portfolios.
Great. And then Mike, from a planning perspective, I know you use a lot of different assumptions when building a plan. How does the prospect of a changing rate environment affect what you're doing on the planning side?
Yeah. So when it comes to, financial planning and just trying to project cash flows into the future, get a better idea of what someone's situation will actually look like down the road. Because the further we get into the future, the hazier things become. So we got to make assumptions today. The way I approach it, typically like to assume slower investment growth no matter what. Rather be conservative there. Also would rather be conservative from an expenses and an expense inflation standpoint as well. So in a way, that combination of we're going to plan on lower investment growth and more expensive expense inflation over time, that scenario works, then we know real life is going to work really well. So I've typically approached, when it comes to an inflation assumption, a flat 3% in all years. The Fed has made it pretty clear, like, hey, we would like to keep inflation under 3%. Over the long term, historically, it has been under that. So now in the near term, if inflation does rear its ugly head, it can cause some near-term cash flow issues for people depending on their situation. But over the long term, don't really expect to see inflation rise above the assumptions we've been making. So over the long term, still expect to see cash flow success from a financial planning standpoint.
Great. Greg, back to you. I'd like to shift gears again and talk of the town's been tariffs for over a year. Continues to be discussion points. What are your thoughts around that, both where we've been and maybe where things might be headed?
Yeah, great question. It's actually tariffs had taken the more back pages of the news, although they're back in again. I think the negative with that is that companies themselves and company managements, they love certainty. They do not like this uncertainty of, well, the tariff rate's going to be this, that, the other thing. There's going to be refunds. No, we're going to put these new tariffs in place. A company management wants to have some certainty so they can plan their business around what is the level. Just give us a number and we can plan around that number and manage our business accordingly. company managements and companies in general for the last 100 years in this country have been very good at working around anything that's thrown at them. But if it's volatile from 1 week to the next or one day to the next, it gets very hard to manage. So having some sort of stability, I think, would be great for the corporate heads that are out there. Again, I have no idea what comes out of the administration from one day to the next, and I think that could be echoed by the company managements themselves. They'd love to see more stability here.
No doubt a challenging environment, and which leads me to my next topic, and I'm going to throw this one to you, Ben. Geopolitics, and markets seem to be kind of shrugging it off. I mean, there was a little bit of reaction initially, but kind of well beyond that. So, what are you seeing there? What are your thoughts?
Yeah, markets have shrugged it off. Basically, at the end of the day, markets are pretty forward looking. And when they look at the geopolitical conflicts in the Middle East right now, they expect them to be, the market expects them to be fairly short term in nature and sort of isolated, so limited to that area. And given that thesis, they're able to kind of look past them. The issue becomes if they drag on longer than expected, or they spread. And obviously, we want neither of these things to happen. We would, just from a personal level, like the things settled quickly into a solid resolution. But the longer they drag on, you get more uncertainty. As Greg was just talking about, tariffs create uncertainty. This creates uncertainty. Companies don't like uncertainty. And then also the uncertainty, and then there's more disruption, especially in the Middle East with supply chains. If companies aren't getting, oil prices going up, but also not getting enough oil, and then that sort of bogs down what companies are able to do as far as transporting goods, making goods, and so forth. And then that can cause disruption. So market will look past it until they're like, this isn't going to be solved. This is going to take a while. We need to start pricing in some downside to this conflict. Hasn't really happened yet, but it's still a possibility going forward.
Yeah, for sure. Greg, one of the topics that sectors, I guess maybe you call it, or asset classes is a better term, over the last 5 years, I'd say that's really accelerated. It's been private credit, and starting to see maybe some cracks there. What are your thoughts around maybe what's going on there?
Yeah, it's definitely become a much more prevalent topic in the financial news. And just to set the basis of what private credit is, private credit is where a entity like a Blackstone or Carlyle, companies you may have heard of before, these are large companies, they are directly lending to businesses, to companies, rather than banks and financial institutions. That's why it's known as private credit. We have generally, probably 99% of the time, avoided private credit at Carnegie for years, if not decades. We see it as a important asset class. However, we do not like the lack of liquidity that these products offer and entail to our clients. I mean, if you want your money back, it's not like you can go and sell and have T+1, which is trade day +1, and get your money in your account. It could take 3 months, 6 months, a year, 5 years. So that lack of liquidity is a major downside of private credit in our view. And we also like transparency. You can pull up Yahoo Finance or Google or a Bloomberg or turn on CNBC and see the price of IBM flashing across the screen. You cannot do that with the private credit. You have no idea what investments they have. You have no idea who's valuing those investments. You have no idea what they're worth. So it's kind of a black box, and we generally don't like black boxes. We like transparency. So our clients generally like that transparency as well. And again, we've generally avoided these types of instruments historically.
Yeah, if you have illiquidity in your portfolio, it definitely changes the planning, especially from a cash flow perspective. If you're someone that has invested in less liquid or illiquid investments and, you know, maybe now you'd like to exit them for one reason or another, probably running into the reality that you cannot exit illiquid investments on short notice. You may be subject to redemption gates, redemption periods. And so all of a sudden, being able to draw capital out of these vehicles can become a quite extended process, as Greg was alluding to earlier. So I think if someone's going to invest in these types of opportunities, sizing it is going to be really important, because we should really consider, what are your near-term expenses? And maybe in this case, to be a little bit more conservative, maybe near-term is 5 to 7 years, 7 to 10 years. It's going to depend on, hey, from an illiquidity standpoint, what are we really talking about? Can you expect some cash flows from these illiquid investments over the near term or over the long term as you're trying to get out of it as well? Maybe they pay dividends on a monthly or quarterly basis. That's something to take into consideration. Obviously, it's not guaranteed, but maybe you are receiving at least some cash flow in the meantime. But if you need cash for expenses over the near term, that should not be capital that should be sourced from the illiquid side of your portfolio, from the alternative side of your portfolio. That's something that's going to need to kind of just be able to cook, grow, and you got to give it time and space, because if the market works against your alternative investments in the meantime, and you were planning on being able to source capital from it on short notice, only to find out you cannot do so, you're going to find yourself in a difficult position.
Yeah, thank you.
Can I just add
Yeah,
Gary?
of course.
I think it's not just the illiquid nature. I think it's also where Carnegie overall investment philosophy and where we want to take a risk. And the credit side it's fixed income. And when we think about a balanced portfolio and planning long-term projections, the fixed income's job is to provide downside protection. And yeah, you can get with private credit a premium to that, but you also deal with illiquidity and lack of transparency. So you're taking on risk. And we want our clients, if taking on risk, it's going to be on the equity side, because that's where there's more upside. And with equity, you get the upside, plus you get transparency and liquidity. So you have the equity has the advantages over private credit. So to a degree, it's like, what is the purpose of this? And from our point of view, it's like, it's not where we want to take risk. We want to take risk in the equity market. And the fixed income's job is to provide downside protection, not add an additional vehicle to complicate your financial plan and your cash flow needs.
Mm-hmm. Yeah, that makes sense. Shifting gears a little bit, Ben, what kind of came into the year? The consumer was in a pretty good shape. Does that continue to be the case? Or are we seeing some cracks?
Well, we're seeing cracks in consumer sentiment. That's as low as it's been, basically in the last 25 years. We're not seeing cracks quite in the spending. That really hasn't come through. I do think consumers, while sentiment is low, savings are okay. Unemployment, the unemployment rate is 4.2%, which means that 96% of people that want jobs technically have a job. So we still have a consumer with the ability to spend. But I do think there are cracks showing beyond sentiment. The savings rate is low. It's not historically low, but it's on the low side. The number of jobs being created is okay. It's sort of a steady state, but it's not overwhelming. The participation rate has gone down a little. So, if you have consumers, low sentiment, feel like it's harder to get a job, or and then wage growth has been lower than inflation, and then wages aren't growing as well, that can lead to a consumer cutting back on the spending. So I think there's more downside to the consumer spending than there is upside.
Okay, thank you. And then finally, just a couple more minutes, we wanted to talk a little bit about some of these IPOs. I saw a mega IPO with SpaceX, and Greg, what are your thoughts around that environment? It's kind of been I don't know if you call it an IPO deep freeze for a long time, but hasn't been that active, and then all of a sudden you've got the largest IPO in the history of the market.
Yeah, it's one IPO has created a lot of excitement. It's one company. If you go back to the dot-com era, 1998, 99, 2000, there were lots of companies going public. In terms of number, the dollar amount comes nowhere near the SpaceX valuation. But you had companies like pets.com and edgar.com. I mean, they didn't have any revenue. They had a lot of clicks on the computer and so forth. The difference today is some of these companies that are being talked about, they do have revenues and they're growing. Anthropic, OpenAI, Stripe, and some of the other names that you've heard out there potentially going public here. Is the market really opening up for those? Again, it's been one so far. There's been a lot on the slate and a lot of discussion. Frankly, the regulatory environment has kind of slowed down companies going public because there's a lot of reporting requirements of companies. And, if you're managing a company, you have to weigh whether or not you want to go public and go through all of that quarterly reporting and the additional noise that takes away from you running the business. So we may see a break in the IPO market. Again, SpaceX is certainly big, certainly one that individual investors know. But whether or not this really leads to a boom in IPOs, I think that still remains to be seen. And a lot of it depends on the market and how the market performs. A good market will certainly lead to more IPOs.